Breathe better and sleep deeper with the Levoit Classic 160 Top Fill Humidifier. Don't wait. Check out the link in the video description to get your Levoit Top Fill Humidifier on Amazon today and enjoy a healthier, more comfortable home.
Welcome to DeFi Digest, where we break down the latest developments in the world of decentralized finance. Today, we're diving into a major update from the IRS that's got everyone in the crypto space buzzing. If you thought the crypto market was already volatile, just wait until you hear about these proposed changes. So, what's behind this new guidance? Essentially, it's all about cracking down on illicit transactions taking place via DeFi platforms and improving transparency and traceability of those transactions. The IRS wants to make sure that crypto brokers, whether operated on a centralized or decentralized basis, follow rules similar to those long followed by traditional finance brokerages. Now, you might be thinking, but only a small percentage of all crypto transactions have been found to be associated with illicit activity. And you're right, it's not like the IRS is targeting everyone. But what they are trying to do is create a more level playing field and make it harder for bad actors to operate undetected. One key aspect of these changes is that DeFi brokers will need to report transactions on Form 1099 DA starting in 2025. This means that any centralized crypto broker will be required to issue a 1099 DA to the recipient of every transaction they facilitate. For DeFi platforms, however, this reporting requirement won't take effect until January 1st, 2027. Now let's talk about what this might mean for investors and crypto advocates. With the incoming Trump administration, it's almost guaranteed that there will be discussions and debates around these tax changes. And given that the IRS can announce code changes, but the Treasury is often the enforcement mechanism, there's a real opportunity for interpretation and different views on how these tax changes will be implemented. There's also speculation that the new administration might adjust or tweak these fees regulations as they come to market. In fact, some are already predicting that we'll see pro-crypto executive orders regarding the establishment of a strategic Bitcoin reserve. And with the Trump campaign indicating a willingness to eliminate capital gains tax for Bitcoin investors and traders, it's clear that there's a lot at play here. One thing that's worth noting is that these changes have faced opposition from the crypto industry. And while on the surface, it might seem like the IRS is cracking down on illicit activity, there are concerns about privacy considerations. With many in the crypto space pushing back against these changes, fears of a central bank digital currency, CBDC, haven't yet been completely extinguished. Now, some folks might be thinking, but wait, didn't we just talk about CBDCs? And yes, we did. Because with centralized stablecoins gaining market share and the institutional and retail interest in them continuing to increase, it's clear that this is an area where investors and crypto advocates will need to stay vigilant. One thing that might be on the table is an exemption or preferred tax status for stablecoin transactions. Given their design and use case, stablecoins are purpose-built to have lower price volatility and serve as a medium of exchange versus an investment or asset class. But even with those facts, stablecoin usage still triggers the same tax reporting requirements as other more volatile crypto like Bitcoin. So what does this mean for 2025? Well, let's just say it's already shaping up to be a high-impact year for the crypto space. With changes continuing to come down the pipeline, investors and policy advocates alike will need to stay alert and on top of things.